Hi, I'm Linda Eedes, and this is an update on the RECM Balanced Fund, our Regulation 28 Balanced Fund. I'm going to look specifically at the first quarter of 2018, look at the returns of this fund, where those returns came from, and then talk a little bit about how the fund is currently positioned. So looking at the first quarter of this year, the quarter started off quite strongly for most markets. Globally, US equities were up quite strongly during the first few months, but there was quite a dramatic turnaround towards the end of the quarter. And in actual fact, US, UK, and European equities all actually ended the quarter in negative territory. In contrast to emerging market equities, particularly areas like Brazil and Russia, which were actually quite strongly up for the quarter. Unfortunately, South Africa didn't follow suit with those emerging markets. It was actually down quite significantly during the first quarter of this year. It was down 6%, and that was largely as a result of Naspers coming under pressure. It peaked in November of last year. It's down more than 20% since then, and of course, Naspers being such a big constituent of the local market, that has quite a significant impact on local equities if you're looking at the index. Fortunately, being value investors, we don't hold any Naspers in our portfolios. I can say fortunately now. We weren't saying that a year ago. It was a distinct negative relative to other portfolios, but because we didn't hold any Naspers in the portfolio, our fund actually performed reasonably well from the local side, and overall the fund had sort of not a bad quarter. It was slightly down, but relative to most funds in the same category, which were actually down quite significantly during the first quarter. And we doing this update towards the end of April, in fact, and the fund is up quite significantly year to date relative to the rest of the market. It's actually up sort of almost 3% after fees versus the sector average, which is actually down almost 1%. So not having exposure to those parts of the market which have come under pressure has been a net positive for the fund in relative terms, and the fact that we have exposure to those parts of the South African equity market which actually started to show a bit of life, the industrial sort of nuts and bolts businesses in South Africa, that actually sort of helped bolster the fact that there is global exposure in this fund. The rand actually strengthened during the quarter, so global equities actually were a net detractor from returns for the first quarter of this year. So looking at new investments in the fund over the quarter, there are a few new investments on the global side and then one or two on the local side as well. And what we're tending to find on the global side is that we're looking for opportunities in those parts of the market which have come under immense pressure. Now, if you think of what's been happening sort of in the global cycle, you're starting to see the global cycle sort of playing through. And that's why you're starting to see interest rates creeping up. So the global economy is kind of working through the cycle. Now, when the global cycle was at a low point, of course, the areas of the market where investors were sort of flooding to were the defensive businesses. So the tobacco exposure, pharmaceuticals, those kind of areas of the market were the flavor of the day. Now that the cycle is actually playing through and commodities have started to pick up and resource sectors started to pick up and luxury goods and anything which has a sort of cyclical component to it is starting to pick up, those other more defensive parts of the market are starting to come under immense pressure. So it makes sense that as value investors, we're taking a closer look at those parts of the market. And certainly the new investments definitely tick those boxes. Two of them are in telecommunications businesses, one in a developed economy in the UK, British Telecoms, and one, Liberty Latin America, is a spin-off from Liberty International, which is actually obviously in an emerging market in Latin America. And these have both been parts of the market which have come under pressure and which offer opportunities for slightly different reasons. BT, because they offer a bundle of products which increases stickiness of customers, which means they can improve their margins relative to other providers who don't offer that. And Liberty Latin America, it's really about the growth opportunity which is present in that emerging market at the moment, buying that at a reasonable price. And spin-offs generally tend to be ignored by the market. The market doesn't like businesses which don't have a track record, haven't been in the market for quite some time. So that's one area of the market that we're looking at. Another new investment is in the pharmaceuticals part of the market. So that's Sawai Pharmaceuticals, Japanese pharmaceuticals business, which has the added benefit of being in Japanese yen. So the Japanese yen is quite undervalued, so that adds an additional sort of bit of value on top of the discount fair value that it's trading in its local currency terms. On the local side, we're starting to invest in some of the businesses which have come under pressure. So British American Tobacco is off more than 50% from its highs. We're actually sort of taking advantage of that by investing in Reignit locally. As you probably know, that's an investment holding vehicle. More than 50% of that is British American Tobacco. So those defensive parts of the market are now starting to actually take quite a bit of strain. So we're taking a closer look there, but as you know, RECM only buys good businesses when they're trading at a discount. So we won't buy a good business at a reasonable price. It needs to be trading at a price which suggests significant value for us. And what we see is that the fund still has some global exposure, but it is not at the maximum allocation. It's kind of sitting in the mid-20s at the moment. You should see that probably starting to creep up. The rand has been very strong. The rand is actually overvalued at the moment. It's actually slightly expensive. So we're sort of taking more opportunities to increase our allocation to the global portion of this portfolio. So overall, you've got a portfolio which is quite defensively positioned. It's positioned very well if we have any more sort of declines in global or local markets. We're away from where the hype has been, and we're taking advantage of the volatility to actually pick up some businesses which are great businesses we haven't been able to hold for quite some time, which are now starting to offer a little bit of value.